Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, the initial public offering or the IPO of Cyient DLM Limited, which is a subsidiary of the IT firm Cyient, is now going to open for subscription for investors on June 27 and close on June 30th. And this is the company that's on our radar today. The company creates low-volume electronics for safety critical segments like in-flight systems as well. And this IPO is entirely a fresh issue of shares of up to 592 crore rupees. Now, this has been reduced from the initial 740 crore rupees that was announced earlier. The price band has been set between 250 to 265 rupees per equity share, and on the upper price band, the firm is now valued at 2,000 crore rupees. Mr. Ganesh Venkat Krishna joins in. He's the chairman and non-executive and non-independent director at Cyient DLM with us. Welcome, sir, and thank you so much for taking the time out for this discussion. Very good morning to you. First up, I wanted to kickstart by asking you to help all our viewers understand the size which had been discussed earlier has been reduced. What is that on account of? If you could give us that clarity.
Absolutely, and good morning, and thank you for having me on the show. The size of the IPO has been reduced from 740 to 700 crores. Essentially, the 108 crores has been pre-placed already with one investor, and therefore the 592 number. But essentially, it's 740 to 700. Again, we just looked at the use of the capital, and we wanted to be most efficient with the use of the capital, given that we also have to be very clear on where the proceeds of the IPO will be spent and will be used. And we just looking at various parameters, just that little bit of an adjustment from 740 to 700 made sense, and that's why we reduced it from 740 to 700.
Okay, got that. And what are the proceeds going to be used for? Like you pointed out, if you could give us a split, if it is going to be used for working capital, then how much? If it is going to be used for debt reduction, then how much?
Absolutely. Just before that, I'll just spend a minute on what is the opportunity that we face, given that there are some really strong tailwinds behind this business, both from the perspective of what's going on in a macro sense, that is, companies looking at de-risking their supply chain, companies looking at China plus one. India is becoming a more and more important and viable market, which means that companies that want to be present in the Indian market have to also have an Indian supply chain. And of course, the prevalence of electronics across the board, more and more industries are using significantly more electronics, which means all that put together is one opportunity from a macro perspective or from an industry perspective. Now, coming to Cyient DLM specifically, our customer base, which includes some of the most innovative manufacturing companies in the world, and these are all quite substantive relationships that we have with these companies, along with the fact that we have some very, very high quality manufacturing and reputation for the same, an order book that's almost 2,400 crores, and of course the whole Cyient pedigree where the design piece comes in, and that's a huge differentiator in this market. So net in this scenario, we think that there are a few opportunities. One is we want to reduce some of the external debt. This is not debt that the parent has towards DLM, but some external debt, because it will reduce some of the overheads in terms of finance costs. So there's about 150 crores or so that will go towards external debt reduction. With the backlog that we have and with what it will take to execute on that backlog will require working capital, which I think is maybe 300 some crores, which is what we will require in the next couple of years. And the third thing is we want to continue to invest in efficiency, which includes systems, technologies, processes, IT, and that's the third bucket. Included in that bucket is some money for acquisitions that we've set aside, because the idea is we want to make sure that while we have some very good capabilities, there's still some gaps, and the opportunity is quite immediate for us to address those gaps. So these are the four buckets, I would say: reduction of external debt, working capital, investments into growth, and an acquisition or two.
Okay, so what will be the debt on the books after you repay this debt that you have planned, and what will be the remaining on your books then? And since you're talking about acquisitions, have they been already identified? Any particular sectors that you've identified the acquisitions in?
So in terms of debt, I believe there'll be about 200 odd crores that will still be left, and that's
Okay.
primarily debt from the parent, which we will pay over a period of time using proceeds from operations.
Got
In
it.
terms of acquisitions, more than a sector, we're looking at capabilities. We believe that there are certain capabilities around plastics, mechanical machining, and so on and so forth. And the other thing is also proximity to customers. I think more and more with the whole sort of de-risking that our customers are looking at, they're also looking at manufacturing that's closer to them. So US customers wanting, say, a Mexico or even within the US itself. So more than sectors, we'd look at the capabilities to address those needs.
Okay. Have you also reserved any portion for the employees of Cyient? And if there is a cutoff date, could you help us understand that? Any discount that you may be offering?
There is a reservation for the employees of Cyient. It is. I don't have the exact number, but there is a reservation, and it will be within the price band,
Okay.
possibly at the lower end of the price band, but it will be within obviously the price band.
Okay, understood that. So, as I understand, most of your, designs, they're actually used in, aviation industry. So, is that the major sector that you cater to? Are there other sectors also where opportunities exist for you currently?
So our focus is on three sectors, like you articulated. We're primarily a safety critical, low volume manufacturing company. So there are three sectors that play in well to what we do. The first is, of course, what you mentioned, aerospace, and I say as an extension of that, defense also, because
Okay.
there's a lot of commonality. So aerospace and defense is the first sector, medical electronics is the second sector, and industrial is the third sector. These are sectors where it's really all about safety critical electronics, and so the rigor in manufacturing and the ability to do really high quality manufacturing is a differentiator in these sectors.
Okay. If you could indicate to us what is the current revenue mix like from all these three segments, and going forward, what would be your key focus area?
The revenue mix is quite evenly spread between the segments. Medical is just a little bit smaller, but it's
Okay.
quite evenly spread, especially when you split aerospace, defense. So we've split it under four segments: aerospace, defense, industrial, and medical. And we'll continue to focus on these sectors. I think all these sectors are going through a fundamental change in how they're looking at both the technology aspect, that is how electronics are being used and so on and so forth, but also the supply chain aspects, that is their risk mitigation, how they want to balance their supply chain. So we'll continue to focus on these four sectors, and I would imagine that all four have the same growth potential. So I would imagine that the balance would be about the same even down the line.
Okay. Who are your key clients, if you could help us understand that from these sectors? And current order book, you said, is somewhere to the tune of 2,400 crore rupees. What is the visibility going forward?
So the clients are typically the large innovators in each sector. So there's five clients that we talked about. So I'll stick to those. But if you look at the aerospace sector, it's companies like Honeywell. In defense, it's companies like Thales and Bharat Electronics. In medical, it's companies like Molbio. Industrial is ABB. So if you look at it, a lot of them are the largest innovators in the manufacturing segment. And what we're very proud of is with the top 10 customers, who are about 90% of our revenue, the average length of relationship is 11 years. So we believe that, we've established ourselves firmly. There's at least another five companies of the caliber of a Honeywell or a Thales that we don't have, or we chose not to talk about publicly. But, there's at least 10 of the top manufacturing innovators are our clients.
Okay.
Sorry,
If you could,
there was
yeah.
a second part to your question.
So basically, I just wanted to understand what is the order book visibility going forward from here?
The order book per se is 2,400 crores is the orders that are already with a PO, with a firm date. They can be executed over the next between 2.5 and 3 years. Having said that, that's not just the only order book. There's also there's continuous orders that keep coming that can get executed immediately. So the visibility is very, very good. The pipeline itself is in excess of 7,000 crores, the overall pipeline. So there's three elements to it. There's order book, which is what's already with a purchase order and a firm delivery date. There is something called total contract value, where we have visibility, which is business that's been committed, but there's no
Sure.
firm date or there's a purchase order. That's about another 4,000 crores, and there's a pipeline which is essentially about $1 billion or about 8,000 crores after that. Of course, pipeline there's no commitment, so we can't really count on it yet.
Okay, understood that. Currently, as I understand, and for FY23, the company reported a revenue of 832 odd crore rupees. Now, that was a jump from a year ago period, but the net profit for the fiscal stood at around 32 odd crore rupees, and that's been a slight downtick from the previous year that we have seen, about 39.8 crore rupees. Going forward, what is your plan to increase the profitability going forward?
So the if you look at where the drop came from, it came in the SG&A bucket, which is essentially the sales and overhead investment. From a gross margin perspective, we're doing quite well, both from a gross margin, which is the percentage, and of course the absolute number, which is a gross profit. Okay. On both these counts, actually, we're doing quite well. Last year, especially in the second half of last year, getting prepared for the growth that we're seeing, we've made a number of investments. We've brought in a couple of new leaders at an executive level, both a new CEO and a COO, who are both based in the US. We've revamped the sales team quite aggressively and quite significantly. We've invested quite a bit on systems. We've invested quite a bit on IT. We've invested on supply chain, etc. So if you look at the drop, it's primarily because of that investments in the SG&A category. And so we're seeing two things will happen in the immediate term. We'll see good growth in FY24. So the absorption will be quite significant, which will help us. But the idea is, from an investment perspective, we've made all the investments that we need to. So now the absorption impact itself will be quite significant, which will help us going forward.
Okay, understood that. If you could also help us understand geographically, I believe there are 2 manufacturing units down south. Any plans to expand in the north as well? Going forward, are you also looking at exports as a major area?
Absolutely. Exports is the big part of our business. Almost 60% of the revenue comes from exports. I think almost 70 now.
Okay.
We'll continue that. I think we'll have a 70-30 mix because, like I said, we're working with companies for various reasons. And one of it is globally, we are a very competitive manufacturer. That's why if you look at a Honeywell or an ABB, what we manufacture gets shipped for their global operations. It has nothing to do with their India operations. Whereas, of course, there's others where the India operations plays a key part. So we'll continue to do that. I think exports will be, we want to have a good balance. That's one of the things that we believe is important in this business. We want to have a good balance between exports and the India market. In terms of expansion, I would say right now in India, we have a fair amount of capacity still between the Hyderabad plant and the Mysuru plant. We'll continue to use those for now. The first objective as an expansion is a bit outside of India because our clients are looking for proximity, are looking for just in time, and therefore having a little bit of at least final assembly next to where they are makes a lot of sense at this point.
Okay, understood that. Any plans on how do you deal with competition in your space right now? There have been a few players that have got listed in the similar area as well. So how do you maintain your edge and your USP in that space?
See, I think our USP really comes because of a couple of things that we've chosen to do. What I said, safety critical electronics, the rigor the rigor in manufacturing, the rigor in certification is really very, very high. I mean, it's a very high bar for entry into these sectors, be it medical or aerospace or defense. So I think that's one element that really differentiates us, the markets that we play in. The second element is our client base. If you look at it, revenue is coming from, like I said, the largest manufacturing innovators in the world, which is a big differentiator. And the third element is the quality of what we produce. We're very proud that we produce some of the best quality. And again, it's important because of the type of industries. So we believe that with the fourth element, I'll say, is the global nature of our business. I think thanks to the Cyient legacy, we've really built a very global organization, and that continues in DLM. Be it the sales teams or the leadership, I don't think anybody has the globalization that we do in our leadership and how we approach business. And that's been a big differentiation for our clients. And we continue to build on that. I'm quite confident that the top 10, we're very strategic, and if anything, will only grow quite significantly in the next couple of years.
Absolutely. Hopefully the same as well. If you could help us understand any immediate challenges that you foresee, since you did say that, you're heavily dependent on exports as well. The global nature, on the one part, it is going to be diversifying for you. But on the other hand, how are you looking at the concerns of slowdown, in the western parts?
So I think there is definitely, there's always challenges. Otherwise, there's no sort of fun in life. But I would say, the opportunity that we have, there are sectors that are slowing down, or there are sectors that will slow down. For example, you look at something like oil and gas, which is very dependent on the oil prices. The chances are that oil prices will correct. Again, will it happen next month or next year? We don't know, but it has to happen. That's the nature of how it works. But I think the key for us is to look at, so we've addressed the challenge by really having the right portfolio and the diversification, right? The great thing about the defense business, for example, is it's a very steady business. It's a stable business. It might not grow like some of the other sectors, but it provides a base on which we can grow our business off of. So having the right diversification has been an important element of what we do. The second thing is, where we're also seeing a lot of opportunity is there's a lot of change that's going on, more electronics, new designs, and so on and so forth. That actually, when a new design happens, that also gives our clients the opportunity to look at new suppliers. And that's where we are coming in, because, even something that's been manufactured for the last 15 years has now undergone a design, and therefore there's an opportunity for a new supplier to come in. So I think while there are challenges in terms of how the economy is performing or potentially will perform, of course, we had a big challenge last year in terms of the supply chain, electronics not being available. That has been addressed to a great extent, and so on and so forth. So I think the opportunity set in front of us is significant enough that we can address the challenges quite effectively.
Okay, since you also mentioned about defense, the sector has been in keen focus because of our Prime Minister Modi's visit to the US, and a lot of opportunities getting emerged from there. Anything that you're looking at that may emerge as an opportunity for you as a company?
Yeah, absolutely. I think, thanks to the work that this government especially has done in terms of positioning us as a very viable, so first of all, as a very viable global security partner, and secondly, of course, as a very viable business partner, means that, the opportunities are opening up quite significantly for companies like us, because, being a global security partner to the US means that you can do many more things than what you could if you're not in sort of the ally category or the highest allied category. So I think it'll take some time usually from what will be talked about and the agreements that will get signed to actually translate into work. But we're very confident that based on just what's happening in the geopolitics and based on India's reputation, both as a security partner and as a business destination, we will benefit quite a bit. I mean, we are already seeing it, but it'll take a bit more time for the full effect of that to come.
Okay, understood that. Well, on that note, thank you very much, Mr. Krishna, for being with us on the show and discussing all these insights. All the very best to you for this upcoming IPO, and hope to catch up again once the company gets listed so that we can discuss more about the business outlook going forward. Many thanks.
Thank you very much. Thanks for your time.
All right, and with that, we'll wrap up this special edition, but do stay tuned on to Business Today TV to catch all the updates from the world of business and stock markets.
If you like the video, do like, comment, share and subscribe.